Friday, December 29, 2023, episode 229. I'm Patrick Ceresna.
And I'm Kevin Muir. Folks, it's a no-guest show this week. So for those who tune in to listen to Smarter Pundits chat, we'll see you next week. For the rest of you, it's just Patrick and me shooting the shit, talking charts, and trying to figure out what the next year might have in store for us.
And don't worry, we still have Crayons with Kevin, no stupid questions. And folks, we might even drink some beers along the way. Lena, hop on. What lunchtime brew are we drinking today?
Today we are drinking Velko Popovichki Kozel Dark from, I think this is from Czech Republic.
It's a Czech beer. But what's interesting, it's a dark beer, but it's light. It's only 3.8%. So it's I'm not going to get plastered.
Kozel Dark might look heavy and rich, but don't be fooled. This deliciously light dark lager will surprise you with its smoothness, unique color, and caramel taste created by 4 different malts.
Actually, I like it a lot. It's actually quite delicious. All right.
All right, let me do the side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much Huddle may include the convexity cankles, the deflation denial syndrome.
You have that.
And Powell pivot paranoia.
Ooh. I suffer from the convexity cankles.
Yeah. All right, let's go to talking charts with Patrick.
Oh, well, hopefully you join me for it too. All right, so let's talk about the top 3 things we were looking at a couple of weeks ago. The Bank of Japan monetary policy, which in the end, they punted it to the new year, right?
Nothing they did not say anything, although there's some hints lately that they've been changing.
Yeah.
And, the yen's actually, as we speak, we're taping this Friday afternoon or Friday at lunch. But the yen is pushing up to new highs.
Yeah. Yeah. And so we'll talk about that when we pull up the charts. Number 2 is the fading the Fed reactions. And there hasn't been a fade yet. Overall, the markets stayed in trend for at least the over the holiday weeks, but it'll be really interesting whether the new year brings some different trends. And number 1 is Santa coming to town? Did Santa show up in your mind, Kev?
I think Santa showed up.
With lots of gifts.
Lots
of gifts.
The largest 2-month rallies, in November, December that we've ever had.
Yeah, it was.
I saw something that the 60-40 was up more these 2 months than ever.
And you know what? When you say that that 60-40 is up, I actually, like we talked about the last episode, I think that's going to be a trend in 2024 where the 60-40 portfolio will be back. And
I like it. Let's talk about that in a bit. You know what?
Okay.
Because I'll take the other side of that.
Okay, so let's talk about the top 3 things to watch going into the first 2 weeks of the new year. And in that theme, we want to say, well, is it going to be a new year and new trends? Obviously, the last 2 months, we have seen very clear trends established. Obviously, a huge market rip, a dollar weakness, all of these things. Does the new year, starting January, bring some new trends along the way? Do you think that some of these moves are going to reverse and start to revert?
Yeah, 100%. I think that we're a lot of people degrossed. A lot of the hedge funds got flatter, and I think that we're going to see a situation where new trades are going to put on come January, and it'll be interesting to see what they are.
Now, typically, from your experience, do you think the volume will start returning right on Jan 2nd, or do you think that it's still going to be a quiet first week before things really fire up?
Well, listen, this week between Christmas and New Year's, have you ever seen a slower week?
No,
it feels like nobody is.
No,
like
but I'm talking about next week, though.
No, I understand. What I'm saying is, it seems like everyone took this one off. So I suspect that all else being equal, the next week might be a little more volume than we might expect and otherwise.
You know what's the interesting thing? People like to usually take 2 weeks off. And because the Christmas holiday didn't start until that one weekend after the 22nd, then we're only 1 week into the period after Christmas. And so if people like taking 2 weeks off, they'll taking off next week might actually mean that there might still be some, maybe what it is, it'll start quiet up until the jobs numbers. And well, we'll talk about that. Number two was the inflation numbers, but that's not next week, but the week after, that we're going to see the CPI and the PPI numbers. But I think that that's always been a focal point as to whether we're going to see an uptick on that. And number one was the jobs numbers. And I think that's when the real volume starts to return. Like I think the first few days of the week, next week, things might still be a little quiet. But I think that once that job number prints on Friday morning, we'll start seeing everyone getting back to work.
Well, you could be right there, Patrick. And the other thing I would say is that I remember back when I was on the sell side and I would try to talk to clients in that first week back from either the September when everyone got back after Labor Day or in January. And a lot of times the investment committees would be meeting. So it would take a few days for them to kind of make their decisions. And just exactly to your point, even if they're back at work, they're not trading for another week until they've made some kind of changes.
Right. So let's talk some charts.
Okay,
starting with the S&P. Today, a bit of a down day with 26 points. And we are getting excited about 26 points because the last 2 days were so narrow and tight ranged.
It was unbelievable.
26 points is that 26 points is actually I thought the markets were closed in the last two trading sessions. Like unbelievable narrow range. It was like watching paint dry. But it's good. We needed some time for some mental rest and to recharge because I think 2024 is going to have some big volatility. So it'll be really interesting to see how this, take some time off here, rest, and then we can start the new year ready to go. So what I wanted to do, Kev, is rather than looking at these traditional candle charts on the daily charts, I figure since this is the end of the year and we're looking in the new year, let's do something big picture and use weekly charts. Can you believe that? But let's step back and look bigger picture at what trends, how the year's played out, and what can emerge. And so here I have this S&P 500 cash index.
One second, can I interrupt for a second?
Please.
So this is with TradingView, right?
Yes.
And they copied the Bloomberg colors.
No, actually, I
Did you
intentionally, because it can be customized. And what I did was, since I'm too cheap to pay for a Bloomberg, I wanted to make it look like I use Bloomberg. So I made the chart look like that. I like your
style, buddy. I like your style.
Anyway, but I made it anyway. So we put it on weekly charts here, and so the S&P 500 is actually trading exactly into a double top retest of its 2021 all-time high on the cash index. And it's going to be really interesting, that we find ourselves at this very overbought state in the market. On the short term. What do I mean by overbought? So I'm going to use this, one of my favorite kind of breadth metrics, which is on the New York Stock Exchange, the percentage of stocks that are trading above their 50-day moving averages. And so when we were doing this episode together back in October, I showed this chart and we were talking about how oversold the market was down along that period. And on balance of probabilities, there was going to be some sort of a short squeeze that was going to create a rally. I didn't realize it was going to be the mother of all short squeezes, but there was a reversal. But we went from the most oversold market in 2023 to now the most overbought market in 3 years based on this metric.
Wow.
And it's like at 86. We haven't seen this kind of a print until since 2021. And to me, that in itself is not like, oh, that's a certainty that there's going to be a market turn. But at least it reflects where we are in the opportunity. Basically, anyone buying the market here is buying it in a very overbought state, and they're really only getting in based on FOMO. It's like, shit, this market's making money. The market's up at its all-time highs. I got to get in. That's the only way you can. But when you look at it from a perspective of, there was a 700-point rally in a couple months. Like this, at this stage, you have to think that the market's got to pause and mean revert. and it bumping its head along the highs is actually a very common resistance level. And so one of the key things to watch going into the new year, in my mind, is does the S&P find resistance there, or even better, does it prairie dog that high just to sucker, create the headline print? Everyone's, oh, the S&P all-time new high, and everyone gets excited about it, and then it just reverses, and that was a short-term swing high.
Well, I tend to agree with you in terms of it's never going to be a perfect double top, and it's going to suck a lot of people in and do something that we're not expecting. I saw Jason Shapiro, our old-time guest of our show, say something like, the market will go down when all you guys stop shorting it. And to that extent, I agree with him that sentiment needs to change and people need to stop fighting it a little bit and almost accept that it's going higher, and then that's when it's going to turn. Like if you think back, like you were talking about the October point, when it was bad, think about how awful sentiment was during that period. And it was mainly driven by the bonds, which have rallied a lot. Well, I'm sure you're going to talk about the charts there, but just think back to the comments that it was like, the U.S. isn't going to be able to fund itself, term premium, blah, 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 blah. Meanwhile, we've just had one of the biggest rallies ever, and very little has changed from a fundamental point of view. It just goes to show you how difficult this market is in how much it flips from one sentiment to the other.
Yeah.
And that is, I think your chart, can you pull it up again? That where you talked about those, the percent of overbought versus oversold.
Yeah, it's just,
I think that's a great chart. And I think that really shows the speed upon which we have flipped from kind of being very pessimistic to very optimistic. The question is this a new kind of reality of how markets are?
Well, I mean, the markets are always adaptive in a sense that it is always a reflection of all participants. And as participants learn new things and develop new ways of trading, then the market is simply a reflection of what is the fair market price of where people are willing to trade based upon those methodologies. And so to me, it's always an evolving thing. But I feel that overall, this market, you're right, is it's going to only turn down once no one wants to short it.
Yeah. No, I think Jason's bang on. But at the same time, Patrick, I really do believe that the market is sped up in a lot of different ways. Like, I don't think the market has changed as much as we think it has, but I do believe that it's sped up in terms of their discounting, either scenario back and forth.
Yeah.
And it just goes from one extreme to the other much, much more quickly than it ever has.
Yeah. And so one of the interesting things for me, one of the things I do believe is much more likely is that we're going to have a market that even if it corrects here, it will be bought on dip on the first correction. And it's going to have to lose momentum before it turns. The only thing that I could imagine happening that could cause a massive and rapid reversal would be, let's say, an unemployment print that shocks everyone, or something that just comes out of the blue and people are not expecting. That could create like a V-shaped reversal. But I think that's an outlier. On balance, things like the jobs number are likely to still not disappoint in January.
Right. But Patrick, you say not disappoint. I'm almost confused about what the stock market would want from jobs.
Well,
like real big, strong number. Do you think they want that?
Okay, so here I have the unemployment rate. This is the chart of on using the Fred economic data, and you see the gray bars overlaid the recessions. And the one thing that it has to be accepted by all listeners is that unemployment only starts rising when you're already in the recession. And everyone's been waiting for this data print to somehow weaken as evidence of, but like, to me, we're not in a recession yet. And the jobs numbers is reflecting that it hasn't yet started.
Right. But Patrick, there's one second, I don't mean to interrupt, but I just got to push back a little bit on that statement about that it only starts rising once you're in a recession. Don't forget, recessions are called, after the fact. And not only that, so we're going to see it rise in kind of real time. And there's all sorts of great indicators out there, like the SOM indicator that shows that, small upticks are often kind of the start of something more sinister. So it wouldn't, I'm not sure that you're correct that this is kind of, we're going to see kind of 6 months of jobs before the market starts to get worried about the economy. Of job losses.
The point I think I'm trying to make, though, is simply the fact that it would take something like the jobs numbers in order for the market to start turning right away, and I don't think that will be what we see.
Right, but I don't even know, Patrick, if let's just say we had an uptick in unemployment.
Yeah,
is that necessarily bad for the stock market? I'm not even sure. I think everyone thinks that they understand and know the answer. I would contend that if you gave a lot of the vast majority of people the actual number in advance, they still wouldn't be able to make money off of it. That's how
you would. Yeah, I generally think that you have to look at a much bigger picture, which is ultimately whenever the Fed tightens, it ultimately slows the economy and often leads to a recession. And ultimately, while a weak jobs numbers during a bull market would be evidence that the Fed is going to stay dovish and stay easing, and that would be interpreted bullishly. In this circumstance, at this stage of the cycle, I think that an uptick in the jobs numbers is going to ultimately be evidence that the tightening was truly did create tight credit conditions that are now impacting the economy. And I think that might cause it to actually be interpreted negatively.
Yeah, I'm not disagreeing. I don't know. The only thing I guess I would be confident in is a really strong jobs number is bad.
Okay.
And my thinking is the market is priced in a lot of cuts. And let's face it, bonds and stocks are moving together. The correlation is still positive between those two. And I suspect that if we got a really strong and the economy ended up being way stronger than people expect, then I could see a situation where that would actually drag bonds down and stocks would come with it.
Yeah.
So I'm not sure exactly what the stock market even wants, except that I know it probably doesn't want a really strong employment number. If I had to guess, I would guess that just in line is what the stock market wants.
I'm actually, and you know what? I actually think that on balance of probabilities, you should be expecting an in-line number. I don't think that this is the shock the month that catches the market, and that maybe that's why it would be a shocker, because I think a lot of people in our camp, which is thinking that it isn't going to be a surprise number, and I'm still in that camp, so I don't think that the jobs numbers moves it. By the way, I wanted to then say, so what could cause the market to when is the next kind of pivot point? And I think that the interesting thing at this stage is going to be the Fed meeting on January 31st. Like right now, there's an 85 based on the CME Fed Funds Fed Watch tool. The market is pricing in an 85% chance that the Fed is not moving here in January. But I think it's going to be very important, though, because I feel what Powell says in this meeting is going to be very important, because the March meeting is where they're pricing in a 75% chance that we're going to see the first cut. And I think that the market, this is what they're expecting, and what Powell says on the Jan 31st meeting is going to and obviously everything leading up to it is going to be the potential market event. So as we get past the January OPEX and get into this Fed meeting, I think that this is where the market has the greatest chance of big volatility coming back in. So it might be actually more of the same in early part of January. Things kind of correct and then rally again. Things are kind of calm from a seasonality perspective, and then things get really interesting at the end of the month.
I think that's a great point in terms of the Jan 31. And by the way, it says Jan 31, but it's a 2-day meeting. So it's actually a Feb 1 announcement date. So that meeting, if you are going to cut in March, you should be setting it up in that meeting. So it will be interesting to see what Powell does there. I got to think that the market is a little ahead of itself in terms of assessing the possibilities of that?
Look at it. Look at the probability distribution going to December. I mean, they're talking about the belly of the probability distribution lies at 350 to 400 basis points. They're talking about close to 150 basis points of cuts by the end of the year is now speculated at in the market. I mean, that's a very bold thing that the market is saying. Like, without a recession, why would the central banks be that aggressive in cutting?
See, one of the problems when we look at this, though, Patrick, is that we're sitting and saying that the market is pricing in this amount of cuts, and what not enough people realize is that it's a weighted distribution of the possible Fed paths. And if we think about it, in previous cutting periods when there was a bad recession, let's just take 2008, for example, they cut a lot. Like, it was, I can't remember what the number was. Let's just say it's 400 basis points in a year. So if you're going and you're trying to assign the possibility of different paths, you need to accept that this is one of the outcomes, that we have, real quick 400 basis points over the next year. So let's just say that there's a 20% chance of that occurring. And then if you say, let's say, there's a 80% chance of 100, it makes it look like the market is expecting more cuts than that it actually really is. It's just assigning, it's kind of looking at the tails and saying that there's a possibility of that tail. Right. And I think that's a really interesting point, that people get too hung up on this thought about where the Fed goes. And I think can you go back to the chart about what you say the Fed tool is, where it says over the next year. Could you go to the next year?
Yeah.
So you're saying that over the next year, they're saying the target rate is going to be down. The most likely scenario is down 100 basis points.
Well, 375 to 400 is 37%, and 350 to 375 zone is 36%. So, you're sort of want to put it in the middle of that, 375. Okay. So 150 basis points.
Right. So my point is that that's where the most likely outcome is. But to me, it feels like if you actually asked kind of me to say where it will go, I think there's a greater chance that it's 0 or 300, meaning that you know what I mean?
The outliers.
Yeah, I think that the outliers are underappreciated on both sides. And actually, I would say that the outliers on the downside, where everyone's expecting, a big recession and big cuts, those are probably fully priced. So I would say that the chances of just unched is higher than the market expects. Like, I could see them doing nothing for a whole year. And I get it. I understand all the arguments the other way. I could also see them, cutting 350 basis points. But I just think that this assumption that the market's always right and the market knows these things is way too. No, I just think a lot of people say that, like, they go, oh, the market's priced for this. And they go, well, let's think about what the market was priced for in September. The market got it completely wrong.
But this is what makes trading is that when you believe the market is mispricing something, you position your trades to profit from that. So
100%.
This is not.
I completely
agree. This is not about the fact that we're saying the market is right. This is where we can put our trades on in the view that the market is mispricing that. And and that's, I think, going to be the more interesting thing, is to see whether, because the way I agree with you 100%. If there is a recession that comes in the first half of the year, I think the Fed will be cutting way more than that. But if there is no recession, they might, and it's all the can is kicked forward, they might stay at this higher level flat for longer, and everyone that's getting all excited about a cut in March is going to be disappointed.
Right. And listen, the economy could surprise. Look, I understand all the reasons why the economy might not surprise. Might roll over. Yeah. But the economy could still be surprised for this long. What if we went another year of the economy continuing to surprise? Wouldn't that be the outlier?
I'm still in the recession camp, because my bear cap is on. But I get you.
Yep.
Let's move on though. I want to talk about the dollar index, and obviously it's been with this kind of pivot on by Powell, and especially relative to, let's say, ECB and other things like this, weakened the dollar. But overall, the dollar in the much bigger picture is still in a primary uptrend and is approaching what were all the major dollar highs around this 100 pivot throughout 2015 through 2020. And so we have a scenario where the dollar is going to give a lot of information, because in my mind, any dollar that legitimately breaks down below this 100 level, and it's a nice, beautiful round number 2, means that the window's open for this thing to go down to 90. And that would be a monstrous tailwind to things like commodities and other assets that benefit from U.S. dollar weakness. Now, I'm not necessarily predicting that. I actually think that during some form of liquidity event, the dollar could still take in some heavy flows. But I'm just trying to highlight this 100 pivot is right here. I mean, we basically were under 101 just yesterday or the day before. And so we're at a really important moment technically on the big picture charts as to whether the dollar downtrend continues.
Can't disagree with you, Patrick. And I think also, if you step back and you think about this on a longer term basis, and you highlighted this, the uptrend is still intact.
Yeah.
Right. Like, so from a longer, don't you agree? Like, this is just a correction in the longer term uptrend.
Like, look at this downtrend in the euro that's been going on for a decade. Now, is this a chart that you're going to get super excited about? At least not yet. The U.S. dollar yen, I mean, it's been a correction, but the pattern of higher highs and higher lows is still intact. And so I actually believe that when we get on the other side, I still think that we're going to first see a recession, and then will come the easing cycle that has the stimulus restart up the global economy. It'll come from China and Europe and everywhere, and there'll be a good period. During that period, the U.S. dollar will be weak, but I think the U.S. dollar may first go up before that kind of multi-year cycle of dollar weakness kicks in. And I think that's going to be the kind of trading timing thing of, like, you don't want to get too ambitious about a dollar short, because there still could be a swing higher. But when catching that pivot, there's going to be some big money there.
Well, could be. I think that to one extent, you can just sit and wait right now. You don't need to get excited either way.
Yeah. Yeah, I think so. And so let's talk gold. And what's interesting about when you put gold on a weekly or even a monthly chart is that while we've had numerous tests above 2,000, I'll even put on a monthly chart. When you put it on a monthly chart, on a monthly closing basis, this is the highest monthly close that gold has ever had.
Yeah. You know what's amazing about this, Patrick, is no one cares.
No one cares.
It's great. Yeah. It's great for the bulls. Let's face it. The worst thing that could happen is you'd have this and everyone's talking about it and everyone's already long and there's all this excitement. A market that's going up and nobody cares and is hitting all-time highs, that's a perfect setup. I'm really encouraged by it, and I think it's great. So the less amount of people that are excited about it, the better off we are. And so, Patrick, on a daily basis, I'm sorry to interrupt. On a daily basis, we actually hit an all-time high yesterday or 2 days ago.
On a
closing basis. That's right.
On a closing basis, because it did have that intraday little pop and drop that.
Okay, but let's talk about that, because think about how demoralizing that day was. Like, that day was brutal. Like, we opened up on a Sunday night, gaps higher, trades at an obscene level up there, and then for the next 2 weeks gets sold hard, right? And it felt like didn't it feel terrible at that point? It really did.
But no, I actually had a very different. I mean, you're right that that's the way the majority of people felt. Okay. But to me, I absolutely hate giving any validity to a Sunday night move on low volume. That somehow this was when the big major bull market was about to start. It was a low volume period where someone just freaking hit all the asks on the side and just and it ripped, and then they just someone that saw it up there just sold into it.
Yeah, I gotta correct you 1 second.
Okay.
all the pit traders are going to be really upset with you for saying hit the ask. You take the ask and you hit the bid.
Okay, they took the ask. Thank you. Sorry about that.
No problem.
But to me though, I actually am not 100% so sure that it's all upside right off the bat. But one way or another, I'm very bullish throughout the year, particularly when we get to the point where all global central banks start easing and we're in a new easing cycle and interest rates start coming off and liquidity starts coming in. I think there's going to be a spectacular gold bull market. I'm just not so sure January 2nd out of the gate is when all of that huge upside comes roaring in. I think the market can still check this rise for a few months, but overall it ends on the upside. That's where
I think you should be careful though, because I think that your dollar bullishness is holding you back here. And as we've seen, the gold is decoupled from the dollar. It's decoupled from interest rates, especially. It's trading completely different. And I don't think enough people realize that. It's trading completely different.
Okay, so the where, though, I think gold will still have issues is going to be if, and that's an if, because I'm not saying there's a certainty, but if there was a liquidity event of some sort where the selling came in very hard, then everything gets sold.
Okay. In a deflationary episode, you're right. It's going to go down, but it's going to go down less than everything else.
Less than everything else, and it's going to be a buy on dip. And so what but what's the beautiful thing about gold is that the skew on options is this beautiful smile, and you can hedge wrap the shit out of your gold positioning for a credit. You don't even have to, there's not even a debit the way you would traditionally have to do, on S&P or something like that when you're collaring. And so you can have all sorts of protection put on there to kind of be able to buffer short-term volatility. And then you can hold your gold throughout the whole period and not even have to worry about it.
Yeah, I would never want to sell the upside. I know that the upside's part of the smile trade's really expensive versus everything else. But to me,
your 1,000 point update shit is just
no. It's a week, not a day. It's a week, and when it happens, you will have a little party.
Oh yeah, okay. Well, listen, I'm not going to complain.
Okay, let's go.
By
back
the way,
to no, 1 second. Go back to the chart though. Just okay. For one quick second, if I showed you that chart and you didn't know what it was,
I'd be bullish. Absolutely,
right.
Absolutely.
So that's the thing. I think you got to step back and stop thinking about all the other stuff and just look at the chart.
It's a bullish chart. Yeah. It's a bullish chart. There's it's a bullish chart. Yeah, absolutely. But let's talk about gold miners. You did a little piece on the miners, and you were talking about how they've been left for dead for how long, and it'll be really interesting. First of all, gold miners, while they've been left for dead, they have not been in a downtrend. They've just been left for dead. And one of the interesting things, if I can draw with a very thick crayon here that cuts one line, but generally, if we had miners in any way break out of this trade range, get up into the mid 30s, that and gold, let's say heading to 2,600 on the upside. I mean, this could launch this thing to $40 to $50 on the upside.
Don't be butchering my trade.
Well, you wrote about it. Okay.
They are so dead. They are hated. Nobody loves them. Our buddy Ronnie Stifferly, I hope I said that last name. Is it last name right? He was reporting back to me from a Switzerland gold conference. He said the miners, even there, nobody cared about them. And the title of my piece was something like "You have to care to hate." They don't. Yeah. People don't even hate these things because they don't care enough.
Yeah, and that's where opportunity presents itself. Let's talk crude oil, and obviously, it's been weak. And the thing is that this is a balancing act of you can't be bullish on the economy and bullish on the recovery and at the same time hate oil and think it's going down. Like, which one is it going to give? To me, this is it coming down temporarily below 70. Yeah, I mean, we could even see, $65 on a little bit of volatility. But but this move from $90 down to 70, I think that the worst of this sell-off is pretty much rearview mirror. And I think that there's plenty of room for us after a January basing period for there to be another round of buying in the energy space.
He's bullish. He's bearish on the economy. He loves bonds, but he loves oil too. The paradox that is Patrick Ceresna.
Well, listen. If there is a recession, then the whole trade gets pushed. You're not wrong about that. All right. So what is interesting, by the way, is how, so let's talk about the VIX for a moment. Now, volatility is low, and rightfully so. When this was the end of November and you're overlapping 30-day forward volatility into the holiday season, it being at multi-year lows, I could drink that Kool-Aid. That's something that makes complete sense. But what I find fascinating is when you go to, let's say, 1 year volatility. This is the 1 year VIX, and we basically are at the lowest levels we've been since the Volmageddon, the COVID spike. And so it's interesting that right now the market is not commanding very much volatility premium for a year that could have a lot of surprises.
Patrick, I didn't even know there was a 1 year VIX.
Yeah.
Thank you, my man.
Yeah. There's a 6 month. There's a 3 month.
I knew that. I just didn't know that there was a 1 year. Wow. Yeah. Well, this is great.
Yeah. And anyway, but the point is that it's from a volatility perspective, it's the lowest volatility metric for a 1 year vol that we've seen since 2019. Let's anyway. Let's just hammer a few more things out. Obviously, in that whole energy story, what is going to be very interesting is whether or not gasoline turns. Obviously, we have inflation numbers that are coming out in a couple of weeks. And so long as oil and gasoline and things like this stay down, I don't think there's any upside surprises to inflation. I think these kind of inputs are going to be really important. And when we ultimately see them uptick is when the inflation numbers will start to reflect that. So to me, this is also at a pretty important support resistance line, very much like oil or these other ones. And it'll be interesting to see whether gasoline can hold the $2 round number per gallon. I think it will, though. No comment?
I was just thinking about it while you're speaking about it. I think that's been a big kind of driving factor in terms of inflation. Mm-hmm. And I think it'll be important to the keeping inflation low for that this doesn't take off. So if you think about the market often goes to where it'll hurt folks. And if you think about the Fed, the last thing they'd want is gasoline to rally up. And it almost seems like maybe it would do something like that, just kind of mess with everybody. So I'm with you. I like, gun to my head, I'm long this thing, not short.
Yeah. I wanted to touch on copper. And copper has been in a pretty distinct trade range. Actually, let me put it even on a monthly chart and highlight that it does look a little like the gold chart. And the much bigger picture. I just don't think that this starts to rally right away. But one of the trades going into the latter part of the year, into 2025-26, will be seeing when copper makes the bullish breakout out of here, because that could send this thing to $6. And that would be a multi-year trend, though. That would be like a end of 2025 target, not like a one impulse higher. But you can see this is a horizontal triangle consolidation. I don't think copper is going below $3, even if it did a temporary dip down towards its 2022 lows. It's just about identifying when is that moment when this chart bullishly breaks out and really starts a new trend. I don't think it starts in the first half of the year, but I think there's going to be big money made if you can catch that breakout.
I know our buddy Paulo Macro is a big fan of the copper, shifted his focus to that. I'm with them. I actually think that not a lot of people are talking about it. It's one of these.
I just think it's early. I think it's going to be a trade that will work. I just don't. I think it's too early in the year to get excited about it. I think copper can easily work its way back to 350, even down to 3.25. But that was just noise. That's just the squiggles that are coming in. But when that big bull breakout does happen, you want to be in.
Okay.
The other thing I wanted to touch on is obviously uranium. Congratulations, Cuppy, on a great trade.
Oh, wow. Did you nail that? And he just stayed with it. Just like the greatest bubble rider of all time.
But I'll tell you this. I don't think uranium is immune to behaving like every other market. And at some point, this rise will get checked. There's too many people that are jumping on for the momentum trade that are weak hands. And the market does this over and over again. Doesn't matter what market it is. There's going to be a point where we're going to have like a 20% pullback, and it's just going to wash out everyone that was way too over leveraged this trade. And there's going to be another great buying opportunity. I still am bullish uranium. I think it's going to I think that bigger thesis is still right, but this rise will get checked at some point. I think anyone who's not in the uranium trade, it's kind of a hard call to tell people to start buying up here. You got to wait for some sort of a correction.
I'm not going to Kucher it. I don't want to get the uranium mad at me.
So no, but I'm still bullish it. So the other thing I wanted to let me put on a monthly chart. This is the commodity index, the Bloomberg Commodity Index, and just it's important to reflect that we've been in a very, very heavy decade-long bear market of commodities. And commodities only started to work legitimately as a basket in this post-COVID period. And this entire pullback looks like a typical flagging formation that's a buy on dip. It's almost like a cup and handle formation. I think that after whatever 6 months, this is a monthly chart, so we might still have months, half a year even, of this kind of grinding. But I think that the next major commodity bull market breaks out of this wedge on these monthly charts sometime in 2024.
I don't disagree. I just think it's funny that you're kind of a dollar bull. And because I think that commodities.
No, I actually think that once all central banks are easing, I'm quite bearish the dollar. I think the dollar bull is just during the kind of liquidity event that could happen in what I still think is a higher probability recession that will emerge. Not necessarily have to be a bad recession, but I still think there's going to be a recession. I still think there's going to be stock market turmoil, and during that period, the dollar is going higher. But I think that once the central banks start dumping liquidity in, we're going to have a multi-year U.S. dollar bear market.
There we go.
And that's going to be very bullish for commodities.
Got it.
Right? Let's talk bonds. And what I want to highlight is obviously this is a monthly chart on the 30-year bond futures. And that was a 40% wipeout. And you were one of the, you predicted it. You nailed it. You were just 3 years too early. And you took a lot of pain and flack.
That's quite a backhanded compliment.
I remember us being in Chicago at the Trader Expo.
Again. Same story.
And I told everyone on the stage, I told everyone that. I said, Kevin is going to be right. He's just way too early.
Okay, but listen,
I said it.
I was a huge bear, as you rightly pointed out, but you have to give me credit because I actually pivoted. I got neutral down there, and then I actually got long. Remember how dirty I felt?
Yeah.
And I was like,
you felt disgusting.
And it ended up being correct. And I knew that it was right when everyone, me being this huge bear for so long, I started getting lectured about term premium from folks who didn't even know term premium meant, and from about the Fed wasn't able to fund itself. and all these things that were happening in terms of all the hysteria. And I was like, listen, at 5%, this is no longer, such a great short. And in fact, you got to start getting long. What shocked me, Patrick, is the ferocity of the bounce.
Yeah.
Like, this is crazy. Like, I'm actually shocked at how, and I didn't listen, it's tough enough for me to get long. For me to be able to still be long at this point is obviously not going to happen. And I think for the first time now, I'm thinking of returning to the dark side.
Oh, there you go.
What do you think? The world is as it should be. Patrick's bullish the US dollar, and Kev is back to being bearish bonds.
I'm not bearish bonds.
Of course,
but no, I actually though I think that the bond bulls, might be disappointed by the performance on the upside, thinking that they're going to make big money. But what I do believe is that those people that own bonds, let's do the ifs. If there is a recession, if there is a stock market correction, which I believe is my starting it is my starting thesis that this is what we're going to witness in this upcoming year. During that period when equities are doing poorly, I believe bonds will act as a safe haven. Even if they're flat, they're going to be a place where you're going to have yield, and it's going to reduce the volatility that you're experiencing on the equities. And so while we saw 2 years of 60-40 being one of the worst things to be in, I think that it's actually in this upcoming year will reduce the volatility of portfolio, and because you're getting such a high yield, will actually it'll improve your performance.
Well, it'll improve your performance at the stock market creators. But I'm not as convinced as you that that this is a return to 60-40. We're going to get meaningful.
I just think it's going to be. I just don't.
You might get no correlation, and therefore there's probably going to be better things to own as a protector. Anyways, I will say this about bonds. So let's just think about the 2 year. The 2 year is currently at 4.25. The 1 year forward is trading at 360. Okay, 360.
Yeah.
Think about how much easing is in there already.
Yeah.
And one of the things that kind of shocks me is that everyone's sitting there and thinking that, I'm going to buy the 30 year, or let's do the 10 year. The 10 year. And if you buy the 10 year today at 385, and you say to yourself, okay, typically in an easing situation when there's a recession, the curve goes from inverted to a normal shape curve, and it actually steepens. So you have to ask yourself, what do you think is the bottom, the kind of terminal rate in terms of the easing? So if you think that the Fed's going to stop at 3 and that'll be enough to kind of save the economy, and typically the yield curve goes up, the 210s go to like 200 plus, you could have a situation where we actually have a recession and the 10-year goes up in yield. And I don't think enough people are thinking about that. It all depends on what you think.
It's possible.
It all depends on where you think the Fed is going to end up having to cut to in the next kind of recession. So if you believe that this is the going to be a terrible recession, just like 2008, and that we've created all sorts of problems, and that we're going to be back down to 0%, then I will be wrong, and you should own the 10-year because it's going a lot lower. But if you believe that this recession will be mild, and that we could get a situation where the Fed just kind of pulls back and, cuts 200 basis points or 150 basis points or even 100 basis points, then you could have a situation where the 10-year doesn't do as nearly as well as everyone thinks.
All right.
That's
Kev.
Yep.
I think it's time to move on. I think we need to
crayons with Kev.
Crayons with
okay,
Kev.
let's do for sure. Let's do the Nikkei.
Do you want me to use this the fake Bloomberg chart? Or do
no. Let's go back to your
to candles.
Yeah.
What do you want to look at?
Nikkei. This is going to be a simple one for Kev.
All right, hold on.
I want kind of a chart for the last year. There is no such thing as 1, 2, 3, 4, 5, 6. There's no such thing as 6 temple tops. The more something keeps testing to the upside, the more likely it is to break out. That's simple. I think the Nikkei is going to break out.
I've been bullish the Nikkei, so I'm not going to say anything.
Okay. But
you're not wrong. You're not wrong, and it's the key rule of that we have on the show. There's no such thing as a triple top or more, and the Nikkei breaking on the upside is the path of least resistance. Yeah, I'll give you that.
All right, okay, folks, short the shit out of the Nikkei. Both Patrick and I like him.
All right, let's go on. Okay, guys, I gotta excuse myself. We pause the show here for a moment. This beer is getting to me.
Oh my God.
All right, Kev, it's time for No Stupid Questions, and we got to get Lena on here to save the day. Lena, help.
I'll be saving you guys. Hopefully in the new year, things will change a little bit.
Yeah.
Okay, first question here. Hey, Kevin and Patrick. Hope you guys are doing awesome in the wild world of markets. First off, I gotta say, loving the podcast. Here's my burning question. Now, I've been scratching my head over this conundrum. Why on earth are those 30-year interest rates playing limbo and dropping like it's hot? I get the short-term dance with the Fed and all, but the long end, it took a 120 basis point nosedive just because inflation's taking a nap. I mean, come on. Sure, the front end's doing the cha-cha with the Fed's moves, but the back end doing the moonwalk on declining inflation news, growth's flexing its muscle. Short-term rates are chill. Recession risks are doing the limbo low. So why the dramatic fall in the 30-year rates? Kevin, as the all-time bond bear, I bet you've got some spicy insights on this. And Patrick, the thick crayon god of technical wizardry.
Oh, wow. I like that.
Can you sprinkle some of that crayon magic to decode this for us? Looking forward to your thoughts and keep the laughs and insights coming on Market Huddle. Cheers from Geneva.
So, boy, this is, I love this question. And unfortunately, we just talked a little bit about it. Patrick, you should have given me the heads up. I would have saved some of this.
I forgot to read the question before.
I completely agree. I am a little perplexed in terms of the ferocity of the rally, especially at the long end. It feels to me like it's just an offside thing. Like, let's think about, we had Stanley Druckenmiller talking about the steepening of the curve. We had people getting on CNBC saying the U.S. isn't going to be able to fund itself. The term premium, we're going to have 6, 7, 8, 9% interest rates. And there was just such an excitement in terms of on the short side of the bond market. I think that the traders just got over their skis too much. And this is just, once the Fed pivoted, and more importantly, once inflation started to retreat, and it's very important we think about long-term, or not long-term inflation, but forward inflation, not rearward-looking inflation. So once those inflation swaps went down to 2% on the one-year basis, we saw a lot of people getting excited about bonds. I think it's just a year-end phenomenon that was the result of a lot of offsides. I think that the long end's a huge sale. I returned to the short side, the dark side, the last couple of days.
All right. So here's the weekly chart on the long bond. And once again, Kev, I think you're just too early. I think I'm not going to push back and say you're going to be wrong. I'm just, I just don't see why we can't end up still seeing the long bond work its way back to the levels we saw at the start of 2023. I mean, we're not going back to 2020 levels, but the long bond can continue to edge higher for a good chunk of the even a half or a year or even 9 months before I think we get in a situation where inflation and other types of things can start really impacting the bonds to go through another bear cycle. So I just think you're early.
Could be. I'm not going to disagree and say that I'm early. I usually am. But I will kind of push back and say that all the concerns that everyone had about the U.S. funding itself, about term premium, those things really haven't disappeared.
Yeah,
it's not like the deficits are going to get better. We're going to have a ton of supply coming in the new year. I know guys like Andy Constant, he's been a big fan of kind of saying that this rally in the bond market was a function of the Treasury altering their the mix of their issuance, in essence, taking duration out of the market. I'll push back a little bit on that and say that the market had gotten way too excited about the amount of duration that was coming. And so they were looking for any excuse to just go the other way. But I think that we will start to see an increased amount of supply coming in the new year. And I'm gonna push back hard against you, Patrick, and say, I think this is the time to short the long end.
All right. Lena, the
second question here. Kev and Patrick, you two have often mentioned in passing how Fed jawboning could cause, quote unquote, the market to do the work of easing financial conditions so the Fed won't actually have to cut. I am wondering about the implications of this. As far as I know, the market can influence FCI via equity and bond prices. Stocks up and bond prices up, in parentheses, yields down, both ease financial conditions. Is that right? If the market eases so the Fed doesn't have to, that means short rates stay high. How does the landscape look different if the Fed has to cut to achieve the same easing of financial conditions? Who are the winners and losers? Thanks.
Do you want to go first, Patrick?
No, absolutely not. Because
so
only smart people get to answer this question. I have only a dumb answer.
Next question. No, I'm just kidding. This listener has pointed out kind of the conundrum that is the fact that if the Fed if financial conditions ease because they expect the Fed to not be as tight, then the reality is that the Fed cannot have to actually loosen because financial conditions have done the work for them. Just like on the other side, when financial conditions were tightening going into September, if you recall, the Fed came out in September in that FOMC meeting and made some hawkish noise, and then the long end went no bid in that kind of moment of bond bearishness. And then the Fed said, hey, wait, you know what? Turns out we don't actually have to raise as much as we thought because of the reality is that the financial conditions have already done that work for us. I think that the Fed pays too much attention to financial conditions. And at the very least, I believe that the market pays too much attention to financial conditions. The reality is that financial conditions work in very extremely long lags and leads. And we as market participants are sitting there trying to, hyperventilate about every single uptick in the S&P and downtick in the, bond market. And we just had the situation where the financial conditions have eased the most that we've ever seen over kind of 2-month period, or not the most, or one of the most. And everyone was expecting the Fed to push back on that easing because it was so large. And the reality is that the Fed's playing a longer game and the Fed's not looking at the kind of day-to-day squiggles. And so therefore, I think that we have to just kind of keep the longer, bigger picture in mind when we think about all these things.
I also think that there is a trade in fading everyone's dovishness on how fast the Fed will start cutting. I think that there's lots of room for a bit of a reversion, and the probability of a March cut is maybe not as high as everyone thinks. And I think there's a trade there.
All right. Yeah. And in terms of who are the winners and losers, the winners and losers are all the brokers and the sell side that get everyone to trade based upon all those kind of shifting of sentiments.
All right. Lena, where can people submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com. Only stupid answers.
All right. Well, listen. Happy New Year to all of our listeners. Yeah. This is awesome. Another year of Market Huddle. It's been such a pleasure.
It has been a real pleasure. It's been great for everyone to tune in. We really appreciate everybody tuning in, writing reviews, and supporting us. It means a lot. And Patrick, I just want to say it's been a real pleasure being your partner, and Lena as well. It's always great to have you on the show, and it really wouldn't be the same without you.
Thank you.
All right. Kev, where can they find you?
They can find me at themacrotourist.com. And Patrick, where can they find you?
You can find me at bigpicturetrading.com. All right. Let's rate this beer. I love it.
You love it?
I love it.
Yeah, Patrick.
I'm going to give it an 8.8.
Oh, geez.
I haven't gone this high in a long time. It's a dark beer, so it drinks with real
It's
flavor.
A light dark beer, it said.
But it's incredibly smooth and clean, and it's great. I actually love it, and I think I would dare I say so.
Oh, I knew it was coming.
Where did you get this beer, Patrick?
Here in Toronto.
Oh, you did? Oh, I'll have to.
Yeah. By the way, I'm in Toronto.
Oh.
Yes.
But listen, you know what I did?
What?
12 Pubs of Christmas, my friend.
Where did it go?
So he's still drunk from that. That's
Fantastic.
You're getting better at it?
Absolutely.
So
no,
listen, for those who don't know about the 12 Pubs of Christmas, why don't you set the scene for us and tell us what it is?
Well, basically, we have some friends out in London that have been for like a decade or more doing the 12 pubs. It's a very
British thing.
British and Irish, like they love that stuff out there.
It's a shock.
And absolutely. And so we decided to bring it to Toronto, and so we always did that Roncy strip, and we've been doing the same one for 7 years.
Okay.
And
that's a street in Toronto, which, by the way,
yeah.
was rated one of the coolest streets in the world, lately.
Bronzy?
Yeah.
Really?
Or maybe it's Ossington, but it's same area.
Slightly different, Ossington and Rossi. But yeah.
Is it? Yeah.
Am I showing my lack of cityness?
It's like west of Bathurst? I don't know it.
Yeah. Other than my absence last year when I was stuck out of Portugal, other than that, the other 6 times that I've done it, I've completed it every single time.
So you haven't told people what it is?
Well, you have to do 1 pint in each one of the 12 pubs, and we do it. This time we did over 7 hours, but in the past we've done 6 hours. So you have a half an hour in each pub.
Yeah.
Well, no, we factored in the fact that we got to get some grub along the way, and that
you got to do
there's
strict
walking.
rules. What is this?
No,
eating?
but there's
right.
There was actually
amateur
there was
hour.
actually a 15-minute walk that we had to make from one bar to the other, and so the thing is we wanted to have legitimate 30 minutes in each pub, and so we just factored in the walking time.
I don't know. I'm hoping the Irish and the British people will weigh in and tell us whether these rules, whether this is allowed or if this is a bastardization.
It probably is. But anyway, I've completed. But what is impressive is the peer pressure of seeing a small group of us complete it successfully has made the group larger and larger. I think like 12 people finished it. We at the peak had 30, 40 people with us on the crawl. And 12 people went from start to finish.
Do they remember that they finished?
Yes. Yes,
or they're feeling it the next day.
I'll tell you, the bartenders at bars 11 and 12 are never happy. Never.
Just slobbered.
10 to 20 people comes strolling into the bar, piss drunk. It's a mess. It's a mess.
Okay.
What are you doing what are you guys doing for New Year's? Anything fun?
Nothing fun.
No.
Definitely not as fun as the 12 beers, the pubs of Christmas.
No.
Anyways, Patrick's got to go out and do some more drinking. It's lunchtime.
It's going to be 2 weeks of what day is it?
That's right.
And why am I still hungover?
Thanks for everyone for tuning in, and we'll see you in a couple weeks.
Happy New Year, everybody.
Happy New Year.
Happy New Year, everyone.
Bye.